and this podcast is for informational and educational purposes only and does not constitute financial advice. Please consult with a qualified financial professional for advice specific to your situation. The views and opinions expressed are those of the hosts and guests and do not necessarily reflect those of the podcast producers or sponsors. We make no representations or warranties regarding the accuracy or completeness of the content. Hi, my name is Bella Carrasco, and helping others feel more comfortable about investing brings a huge smile to my face. After working in the private equity, family office, and securities markets for nearly a decade, I pulled together my resources to interview experts in each area of the due diligence process and answer how do you know questions when considering your future financial safety. We go deep into questions about many phases of the investment process, with the goal of helping you go from practice to game time confidently. This is the How Do You Know podcast. Also, fair warning that this is episode 2 of a 2-part episode where we go deep into the underwriting. It may also be helpful to watch on YouTube because the guest does go through his presentation on there. I hope you find it helpful. Today, we are learning underwriting from Hans Box. I'll turn it over to you to go through the presentation you prepared for us that summarizes how you vet passive real estate investment opportunities, and I'll interject with questions as appropriate.
Sounds good, Bella. Thank you for the kind intro. Property tax assumptions. This is always a big thing in Texas and some other states as well, but Texas, it's a very big deal. And, I want to know that they're being very conservative with property tax assumptions. Property taxes are a huge knob on the expense side for Texas properties. And I have seen big mistakes being made by sponsors that basically look at the current property tax valuation and don't take it up to the sales price or the purchase price that they're buying it for. And then they get killed in years 2 or 3 when the tax appraisal district figures out that the deal was sold. I mean, there's stories about where in Texas, non-disclosure state, but they do know when a deed changes hands. And so the appraisal district will say, okay, well, we don't know the sales price of this deal, but we know a deed changed hands. So let's jack up the valuation for this deal because we know the prices are high right now. We'll just put a really high price on this. And what essentially they were doing is forcing owners to come in and show their purchase price in order to get it down to the purchase price because they jacked the valuation up so high. So they do these things,
Wow.
and you have to, basically the answer is in Texas, I want to see 90 to 100% of the purchase price as the value in year 1, or they're not being conservative. So, and other states are different, but in any strong property tax state like Texas, you really need to pay attention to this. Rent increases. And occupancy increases. So typically you increase the value of a deal by bringing rents to market or doing a rehab and then bringing rents to the rehab unit market rents or increasing occupancy. That's really how you increase the value of these deals, is by increasing the income. But that's why you as a LP need to dive into that and really understand what are their assumptions and how did they decide that they would increase the income X amount %. So what you have to be careful of, and I notice a lot of this with new sponsors, is they will simultaneously increase rents through doing upgrades. They'll also have an organic 3% rent increase built into that. Then they will be reducing loss to lease or concessions, and occupancy will stay the same. So magically, you just increased income from your year 0, the year you bought it, to at the end of year 1, you increased income 25, 30%. I've seen worse than that. And the thing is that apartments don't turn over 100% a year. So you can't rehab, a ton of units and then increase rents and reduce concessions and get rid of loss to lease and keep occupancy high all at the same time. It has to be staged in. And so what you want to do as an LP is understand, I'll calculate how much their income increase year over year. And if it's much more than about 15, 20%, I'll start really digging in. I'm like, how do they do this? Why? And I'll push back on them and ask these intelligent questions about how can you lower, loss to lease. Lowering loss to lease or getting rid of concessions is the same as increasing rents. So you can't do everything at once. Everything has to be staged in. Otherwise, you'll have people leaving the property. Then your occupancy drops. Well, Magic, their occupancy never goes below 95%, yet they're increasing rents by 25%. And they're doing rehab on, 10% of the units, a month and things like that. It's just impossible to have that many moving parts to increase the income that fast. And so what you really need to be able to dive into this and understand what are the knobs that they're turning and how much are they actually increasing income year over year. They might just tell you, oh, we increased market rents by 10%. But if you don't also notice that they got rid of loss to lease, they got rid of concessions, they raised occupancy, they might have actually increased rents by 25% with those other things added in. And so that's what you really have to dive into.
Yeah, that's a good point.
Yeah, and I see a lot of mistakes being made by new sponsors, and it's not out of trying to pull the wool over everybody's eyes. It's because of inexperience. They do everything at once in the first year, and it's impossible to turn running a 200 unit apartment complex. You got to think about it as like you're turning a ship. You're not on a little wake surf boat that you can turn on a dime, right? You're in like a massive aircraft carrier that takes forever to change course, right? And so to do that, you have to phase these things in. It can't just suddenly change in 1 year. It will really take at least 2 years on a big multifamily property to do a full repositioning of the property.
And for taxes and insurance, is there a place to go to ensure it makes sense for the market? Like, can you go to a tax assessor or anything like that?
Yeah, well, on the property taxes, what I'll ask for if I think they're not being conservative is I'll ask for their consultant's report. They should have hired a property tax consultant to do a report and do an analysis of the properties around the area that this property is compared to, because they do that. The appraisal districts do the same thing. They keep everyone on a similar level, and so they should have something like that to be able to provide to you. Insurance, that quote should be from their broker. That it shouldn't be an assumption that they make. It should be a quote from their broker. Ask for it. If it's from a property tax consultant and you actually have a real quote from a broker, then it's most likely somewhat accurate. And and if it seems too low or too high, again, this is where you start diving in and asking the questions and saying, you got a property tax consultant, but we're still only 70% of purchase price. Why do they think that we can keep the valuation that low when I bought the property for 30% more?
And in these states with high property taxes, so you mentioned Texas is one of them, a lot of deals can get done because of tax credit incentive programs. How do you account for those in underwriting?
A deal that has tax abatement because they typically will provide some affordable housing components in the deal, that is like a completely different deal, right? So I would evaluate them completely separately in that respect. It's a great play in Texas because if you can abate property taxes and not lower your income too much, sometimes it makes a lot of sense. But in general, I don't see, I either look at a deal that has the whole play is tax abatement, or I look at a deal that is just conventional and doesn't have it. So another thing that I look at when I'm looking at the pro forma, as I mentioned earlier, the rent increases and occupancy are usually how you increase the value of a property because you're increasing the income of the property. But I want to understand how they arrived at the rents that they say they're going to get, whether that is market rents, just raising the rents on the current units as they are, or whether that is doing a big rehab, like a $10,000 a unit or $15,000 a unit rehab, where they're, redoing flooring, cabinets, putting in new appliances, counters, all that stuff. They may have an upgraded rent for a comp that is comparable, that's why you call it a comp, to this property. What I want to know is, have they done a very detailed comp analysis, and have they laid that out clearly in the business plan? So I'm actually reviewing a deal right now, ironically enough, that one of my big problems with it is that they are increasing rents a ton. I think they're increasing rents like, I don't know, it's like almost $200 a unit, or maybe $150 a unit. It's a big number on a class B-ish deal, B- deal in Tulsa, Oklahoma, which isn't like this fancy market, right? So 150 units, not small amount of rent increases. they have comps, but they gave me a comp set, and it wasn't very clear looking at it whether they could do it or not, because I couldn't understand, are these comps close to this property? Are these apples to apples units? All these things. It was very hard to tell the way they laid it out. So what you want to do as an LP, you want to see a comp analysis that shows here's the subject property, here's the comps, here's why they're comps, here's their rent per square foot now, here's our current rent per square foot, here's what we're taking it to. Are we actually taking it to comparable properties? Are we actually bringing it to market? Do we have properties that substantiate that we can actually get those rents in this market with this type of unit? Do they have granite? Do they not have granite? Things like that. So it should be very clearly laid out for you. In my example, this is a real life example I can give you right now. I pushed back and asked them for that. What did they do? They just sent me a CoStar comp report, which is just this long comp report. I'm like, no, I'm the investor. Send me your analysis that you did to arrive at the numbers you arrived at. You must have done an analysis. I want to see one piece of paper where I can look at it, or two pieces of paper, and see, oh, that makes sense. We're here. They're here. We're trying to get to here. That makes sense. That's really all I want to see. I want to see a clear roadmap of how you're actually going to, why do you think you can get these rent increases? So that's an example right now that I'm doing right now where I'm pushing back on them and saying, no, don't just hand me a multi-page, CoStar comparable report and make me do the work. It should be, I'm the LP, show me how you're doing it. And that's part of it is I want to see their thought process, and I want to see what the analysis is that they did. Really good sponsors that are increasing rents like this will typically have pages that show matrices and show, okay, yeah, I've seen wonderful scatter graphs showing where your property lies, and here are the comps, and where it's just very clear when you're done reading it, you're like, yeah, logically, I haven't done the comp study. I'm not going to drive to Tulsa and drive around and get rents. But if it's presented in a clear manner and they actually used a comp study and it's very clear and logical that they can increase rents, then I'm usually pretty confident that they've done their work and that at least it's within striking range and it's not some far off fantasy that you do see a lot of nowadays. So very important. If they don't provide a comp report, that they need to. I'm much more interested in rent comps than I am sales comps. Sales comps can be a little skewed. A sales comp today of the same property a year ago is so different because cap rates have gone up so much. So you can't say today, oh, I'm buying a deal, 3 million below market compared to last year or 2 years ago. Well, of course you are, because 2 years ago deals were way overpriced. So now you might actually be paying the fair price for the property. 3 years ago, they weren't paying the fair price for the property. And so, sales comps to me aren't as indicative of, can it hear the rents today? Can I get to here? And is that actually going to increase the value of the property? In the end, that's all I want to see. I will also review this. Sometimes I'll ask for the historical P&L for the property and compared to the sponsored proforma. Again, not planned. I literally just yesterday reviewed this same deal that I've been talking about. And I asked for that exact thing because they didn't provide it. And I looked at their year 1 and 2 rent increases and income, and their income went up quite a bit from year 1 to 2. Okay, it wasn't insane, but it was quite a bit. And I thought they were actually doing some of the things that I warned against in that previous slide. But what I asked for, I was like, okay, that's year 1 to 2, fine. I want to see their year 0 to 1, meaning their first year of operations. So where was the seller's profit and loss, the guy that owns it today, and what are they saying they can do at the end of year 1? And I asked for the historical P&L. That's what that means, the seller's P&L. Guess what? They didn't have it to provide. They're still looking to get financials from the seller.
Wow.
So I'm like, whoa, wait a minute. Huge red flag. How did you put together an entire offering memorandum to me and make projections if you don't have detailed seller financials that you can hand to me today? That didn't make any sense to me. So I'm eagerly waiting their reply. Not really, because I think I've already made my decision on this deal. But it's a prime example of just asking for the P&L raised a big red flag in my mind that wasn't even related to why I was asking for the P&L. The fact that they don't have it is a bigger red flag to me than dealing with the income increases at this point. So that's why you ask questions, and that's why you ask for materials and dive into the numbers.
Yeah, that's pretty crazy. I think that would be a no for me after that. So they're lucky that you're still looking into it.
Yeah, yeah. It'll be interesting answer. I'll update you, Bella, on
Yeah,
what
you'll have to. I'm very curious.
analyzing the pro forma true cash flow. So in this one, what the reason I asked for this is, so typically you'll see a P&L that'll go to net operating income. But net operating income means the net operating income of the property. So only the property, not the entire deal. Typically there's stuff below net operating income that isn't related to the apartment property or the self-storage deal itself. It is, stuff like debt payments, asset management fees, entity level, partnership level expenses, corporate expenses, things like that. So, but all that counts because all that has to be paid before you, the investor, make cash flow. So what I'd like to see is a true P&L all the way to NOI, and then all the other corporate level debt, everything expenses below that, any capex spend that's coming out of cash flow, come down to a final net cash flow number. That net cash flow number then should tie to what they're telling you should make as your cash flow percentage per year as an LP. And that's why I asked for that. Because a lot of times, not a lot of times, but I've seen it where when I asked for that and I figured out that they overraised for the deal and they were actually repaying our own capital back to us as part of the cash flow. And the only way I knew that is because I wanted the full accounting, the full P&L all the way to the bottom. And I would never figure that out if I hadn't asked for that. And I never want to invest in a deal that they overraised to pay me back my own money and call that cash flow.
And when you're looking at the P&Ls, are there any rent ratios or expense ratios that you like to see or consider?
I don't look at ratios that much. I look at individual line items because I've been so far in the weeds so much. So I may not be. I did on the same deal. I did the same thing where I started looking at their per door expenses because I know in my head what payroll for a 200 unit property in Tulsa, Oklahoma. I kind of know high level what payroll per door should be for an apartment deal. It should be probably $1,400. I mean, back in the day, it was like $900 to $1,000 a door to payroll. Now it's like 1,400 plus. Well, theirs was $600 a door for payroll. So it was less than half of what I expected it to be, way less than half what I expected to be. So immediately that was a question. So I looked at individual line items and I looked at the amount total expenses per door and kind of like, because I've been doing this for a long time, looked at a lot of it and I was like, okay, that kind of makes sense. This makes sense. This doesn't make sense. I'm going to ask a question. That is looking at ratios is probably a good thing for, and the thing is ratios differ by asset type. So I don't want to start spouting what ratios to look for here and confuse somebody. But that's a good point, Bella, for a new investor that isn't going to look at every little line item like I did. To understand high level what an apartment expense ratio should be and what a self storage or a mobile home park expense ratio should be, that would be very helpful. And I would look at that. Definitely look at that.
Yeah.
So what I was trying to do here is the full P&L through cash flow. That's the reason I wanted to show this. So if you notice, it's year 1, year 2, year 3, etc. And at the top, we actually show our assumptions, what we were assuming on an annual basis, our rent increases, things like that. And then if you notice, we have revenue and then we have expenses and then you have net operating income. But below that, we have these other asset management fee, CapEx that's paid out of cash flow, debt service, and we get to a number. I can't see the exact number. I think it's about 209,000 or so of pre-tax cash flow in year 1. Okay, and so this is what I meant earlier when I said I want to see a pro forma that goes all the way down to cash flow and not just net operating income, because then it tells me my projection of what I could be making on the deal. So if you actually go to the next slide, Bella, you will see this is something I always like to see. This is, again, same deal, same example, where I want to see as an investor what they're projecting I would make on a deal. An easy way to look at it is for them to give us an example. You invest 50,000, you'll make this, or you invest 100,000, you're going to make this. So what I wanted to kind of impress upon everyone here is, if you notice in year 1, it says 6.3% of investor operational cash flow in year 1 for an LP in this particular deal. Well, what you can do is, if you in the cash flow statement that I just showed you, the 209,000 or so, if you take the total equity in the deal, which is in the sources and uses I showed you all, 3.325 million, you take 208 or 9,000 divided by 3.3, that's 6.3%. So I was able to tie it all together, and there's nothing they're hiding from me. The total equity raised, the total cash flow the deal is producing, then calculates out to what they're projecting for me as an LP to make in the deal. So the whole point of this was to kind of show you the main things you want to see as a LP in terms of defining what you're going to make in the deal and being able to drill down and actually follow the trail of money. That's really what you want to do, is follow the trail of money. It should all tie out, which is what this did. You can get into a lot more detail, but this example is something I like to see a lot because it shows me as an investor what I'm projected to make on an annual basis, and it shows it whether I'm going to make it from operational cash flow, refinance, or sale. In this particular deal, there was a refinance projected, I believe, in year 6. So if you notice, there was cash flow, cash flow, cash flow, cash flow, and then in year 6, there's a return of equity because there's a refinance that we built into the deal. Then there's more cash flow, and then a sale. And so this just gives me an overarching kind of view of what I'm going to make as an investor in a deal. And I always want to tie that to their actual pro forma profit and loss statement. Financing. Huge thing here. This is probably one of the most important parts of a pro forma, and it's where a lot of people got into trouble over the last 3 to 4 years. Many of you may know that multifamily in particular is having quite a bit of distress right now, relative to what it was having before. And much of that is because of the aggressive debt that was being done by inexperienced sponsors over the last few years. Most of that being floating rate bridge debt. And so finance, the lender is your biggest partner. They are typically greater than 50% of the money in the deal. In the end, they have control, and their money gets paid before your money is the LP gets paid. So you better understand what kind of debt is on the deal. If you structure debt correctly, it's a great asset and it increases the returns on a deal. But if you structure it wrong, it can destroy a deal. And so what had been happening a lot in the past, in a few years, is because prices of multifamily were very high, meaning cap rates were very low, the debt that Fannie Mae or Freddie Mac, which are the main two pseudo-government entities that lend for multifamily in the U.S., the loan to cost were very low. They were like 50, 60, 65% or so because the prices were too high. They look at the deal and say, well, we're only lend up to this amount because we think the price is too high. I can get into details of why they only go up a certain amount, but basically what was happening is even on a very stabilized deal that was fully occupied and everyone was paying the rent, they would only lend, say, 60% on a deal. And the reason is because the price was so high. And when you have to raise 40% equity and you're only getting 60% debt, so 40% of the money has to come from equity, then when you do the math, the return for the equity is very low. So in other words, the deals don't pencil. They're not making a very good cash flow, and they're not making a very good return for the limited partners. So these sponsors couldn't sell the deal because if you're saying, I'm going to get you 2% a year and a 10% overall return, nobody's going to invest, right? Well, that magically disappears if you get 85 or 80% bridge rate debt. So basically you get a bridge loan that is much higher leverage because these bridge lenders will take more risk, and they have floating rate debt. So I saw floating rate debt in the 2s all day long 2 or 3 years ago. And so suddenly you take a deal that was at 6% with a 3.5% amortizing Fannie Mae loan, and then you change it from 60% to an 80% bridge loan that's interest only typically, floating rate debt under 3, suddenly the math works. And their returns might go from 2% a year to 6 or 7 or 8% a year. And basically you're reducing the amount of equity in the deal. So of course you're juicing the returns on the deal, but you're adding a huge amount of risk the deals basically were over leveraged, and they were using bridge debt, which is meant to bridge and it's meant for distressed assets, not for stabilized assets. They were using bridge debt to make deals work. And so when interest rates went up 500 bips, and then property taxes went up, and then insurance went up, oh, by the way, rent growth slowed down, and oh, by the way, occupancy went down, and all these things started hitting rate cap, and then they were having to buy rate cap escrows on top of that with these lenders. In other words, basically insurance that the rate wouldn't go up. Those went up because as rates are more volatile, the cost of this insurance product goes up. So all these things hit at once, and suddenly these sponsors that had this bridge debt on stabilized deals couldn't make. Some of them could make their debt payments, but couldn't make any other payments. Suddenly, everything else stopped. They didn't have enough money to do their rehab. They didn't have enough money to pay their investors anything. All they could do is barely break even and pay their debt. And some of them, many of them, couldn't even pay their debt. And so that's because the wrong leverage was put on these deals, and they overpaid for them. So it's a combination of overpaying and too much leverage. It looked all rosy and worked until it didn't. So that's why it's essential that you look at the financing. Typically, you want to see permanent debt, and you want to see fixed rate debt. It's okay to use bridge loans if the deal actually needs a bridge loan. It's 85% occupied or 80% occupied, and you can't get agency lending on it. But if you can get agency lending, then there should be permanent debt on the deal to begin with. You can always stack debt on top of that. So the beauty of agency debt is you can get a 50% loan to value today, but if you increase the value, you can Fannie Mae and Freddie Mac let you add a supplemental loan on top of that. So basically, you keep that debt and then you add a little bit more on top and pull money out. So it's a much safer than trying to do a refinance. It's because you always got that permanent debt. You've got that safety net at all times. So extremely important that you look at whether it's fixed rate, whether it's floating, whether it's bridge or permanent. I look at the refinance. I look at the rate and cap rate assumptions, meaning are they assuming they do a refinance, say in year 3? Are they assuming the same rates as today, or are they reducing the interest rates? I would never reduce it. I would just assume the same rate today. And what are they assuming for the cap rate, the valuation of the property to do the refinance? Same thing when you look at an exit cap rate that we talked about earlier. This is the same thought process. Do they expand the cap rate out to year 3 such that they're not being overly aggressive in the valuation of the property to do a refinance and pull out more money? You want to look at the prepayment penalty. That's very important. A lot of this isn't as important as fixed or floating or things like that. But a prepayment penalty will prevent, if somebody is bought a deal today and is going to sell in year 3, and then you look at their sale assumptions and they don't have a big number in there to pay a debt prepayment penalty, then there's something wrong, because all of this agency debt will have a large prepayment penalty when you sell a deal off in the first few years of the deal. It's just a higher prepayment and it goes down as time goes down. So you want to, again, look to kind of like to see, are they somewhat conservative? Is there an assumption built in that they're going to pay this penalty? Or are they assuming that somebody else will assume the debt? We can get into a lot of details here with debt, but I think what I want most people to take away from here is that you don't want too much leverage. You typically want permanent debt, which in the multifamily space would mean 5, 7, 10-year debt, typically balloon payment debt. And you really want fixed rate if at all possible. That's the biggest thing I want people to take away from this.
Unless it's a development, then floating rate is a more industry standard there.
Yes, you will have floating rate bank debt in that respect, but then you want to ask, okay, what kind of interest rate protections do I have? There are some products that are more fixed if you do a HUD, but that's probably for another day and a much more complicated discussion. But yes, if it's an existing deal, you typically want fixed rate debt.
And as an LP investor, how can one stay attuned to what's a reasonable interest rate when there is a refinance 3-4 years down the road, or even?
The answer is, what is the interest rate they're getting on the debt today, and then compare that to what they're assuming in year 3 or 4. And if they're reducing it a ton, I'd ask a lot of questions, because typically most sponsors will either just expand it will keep it the same or even go out a little bit. Some people use there's these forward curves you see where these different I don't even know how to describe it. These financing companies will put out yield curves and make projections about where they think rates will be. But honestly, if anybody tells you they know where rates will be in 3 years, they're lying, because nobody does. If you did, if I did, I'd be a trillionaire, right? And everyone else would. So to me, you have to look for conservatism built in. You want to at least the rates today, right? So in the ultimate really low interest rate periods of like 4 years ago, I would want to see refinance with a rate much higher, because I didn't believe rates were going to stay at zero forever, and they didn't. Now rates are much higher. They're actually kind of more around a little bit closer to what they've been historically. So if it's the same as it is now, I would probably be okay with that. I just want to see that they thought about it and that they have a logical reason for having the rate where it is. So the last slide here regarding evaluating the pro forma is, again, another example. I pulled this from a deal we recently did, and I pulled it just as an example. Ours is a little robust. I know that. And most sensitivity analyses may not have quite this many knobs. But what I want to kind of at least stress here is, you want to see that the sponsor looked at the deal and their target. If you notice, the middle column is called target. That's kind of what they're projecting in their business plan. That's what they're targeting in the deal. What I want to see is that they looked at a downside scenario. Did they take what their target was and then be even more conservative and raise the cap rate, maybe make vacancy higher, maybe don't get as much rent growth as they thought they were going to get, maybe have more bad debt, or have maybe they couldn't upgrade all the units, things like that. And so you want to see that the sponsor took a detailed look at the downside scenario of a deal, and they turned back some of these knobs and they were more conservative on it. And does the deal at least still make a little bit of money? Or does it completely blow up? They change one thing in the deal. What you're trying to understand is, by moving these few things, how sensitive is the deal? Is it a strong deal with a lot of margin where if you tweak a few things, it doesn't just completely make the deal blow up? Like in this case, we tweaked quite a few things, and it dropped the returns quite a bit. And if everything hit the downside and we knew it was going to hit the downside, we wouldn't do this deal. But we're targeting the 15.4%. The downside is what we think is a reasonable downside scenario that could happen. We're not talking about, full on apocalypse, or COVID time, right? We're talking about what we reasonably think could happen with these different knobs. And so generally what you want to see in here is that the sponsor spent time and put together a logical matrix or a logical representation of what they think the downside scenario could be.
And clearly, evaluating a pro forma in general takes a lot of time and attention to detail. Before you even dive in this deep, do you have a back of the napkin calculation you do?
Yeah, I mean, I'll look at what they're projecting as the overall equity multiple and IRR, and then look at their a quick cap rate, what their assumption is on the cap rate, to see whether or not it even makes any sense to me. Right? If somebody is just buying a value add deal down the fairway in XYZ city in the US right now and is telling me they're going to make a 28% IRR over a 5-year hold, I'm immediately like, bing, 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 red flags. That's because you're just not making those kind of returns. Very rare. I would really want to dig in there. But where I usually back of the napkin kind of, with these deals is, it's really when I evaluate the sponsor and how the business plan is put together and the value add proposition and how it's described. I can usually tell by reading through just that I don't even need to get into the numbers much. I'll know kind of whether, okay, these guys seem strong, their strategy seems strong, makes a lot of sense. Then I'll dive into the numbers. I don't go straight to the pro forma. I want to read about their value add plan first and understand who they are, and look at their very high level assumptions first. And then if that kind of passes the first test and I don't get a bad feeling, then I'll move into the pro forma and really dive into the numbers and start asking questions like I mentioned earlier. When you read enough of these business plans, you will know within the first 10 minutes whether or not you want to really dive in. Because it's quite obvious to read one from somebody that's very sophisticated and has a long track record, and then you read one that's somebody that's very new or doesn't know what they're doing, and it is night and day. You will, as you read more of these, you will be be able to understand it very clearly. But as much as people don't want to hear this is all about repetition. You got to spend the time on this. I think this will probably be the last thing we touch on, at least for this podcast right now. Again, this could be a podcast by itself too, but and I mentioned this earlier, comp models, the waterfall, preferred return, all that, but we haven't really touched on fees. And what I put together here is high level fees that you typically see in a normal standard multifamily syndicated deal right now. It's acquisition fee of 1% to 3%. What I like to see here, though, is if the deal is really big and it's like a $80 million deal, if they have a 2% acquisition fee on an $80 million deal, that's $1.6 million they're getting paid day one. Too much, because it takes just as much effort to buy a $30 million deal as it does an $80 million deal. It's the same thing. It's just more zeros. You just raise more money. So I don't think you should be paid that much more for it. So I typically like to see acquisition fees really between 1% and 2%, but I see them between 1% and 3% for multifamily. Actually, multifamily is usually lower. It gets to 3% more for mobile home parks and maybe self-storage where the deals are smaller. But those are typically the percentages I want to see. Loan signing fee, it's usually 1%. What I don't like is when they get a loan signing fee signing on non-recourse debt, meaning they aren't really taking a huge risk and they're getting a fee to sign on non-recourse debt. It doesn't kill a deal for me, but I don't love it. Disposition fee is just like the acquisition fee, except it's on the back end. You see this quite a bit. Asset management fee is usually 1% to 2%. And then when you add in the management fee from the management company to manage the property, you usually don't want the asset management fee plus the property management fee to be more than 5%. That's usually the range that I see. And construction management fees really is 5 to 10% of the rehab budget. Essentially, what you want to look at is that the sponsor isn't getting rich day one before you, the LP, starts making cash flow and making money themselves. You want their interest aligned with yours. And if they're getting rich day one, your interests aren't aligned.
Well, Hans, thank you so much. This has been an incredible wealth of knowledge. We'll just end with a quick fire round of questions, and starting with your favorite restaurant.
Red Ash in Austin. You can't ever get a
yeah.
reservation there, but definitely Red Ash.
Is it up and running again after the fire?
It is. It is.
Okay.
And I looked at reservations.
Oh,
unless you want to go at 5 o'clock on a Tuesday. That's really your only option.
Honestly, it's worth it.
I agree.
Second question, what brought you joy this week?
Just seeing my family and getting to go home for the 4th of July. Yeah, that's what brought me joy. So got to see my brother and my dad and one of my nephews. So that was fun.
Yeah, family is always nice to spend time with. Last question, piece of media you consume daily to stay up to date on the news?
I'll have to say I don't have a piece of media I consume daily because I don't trust any of the news. I'm just not a big news guy. I do get like the morning brew email every morning, so I'll skim that, if there's some huge headline, it'll probably be in there. But for the most part, I don't pay too close attention to one specific news source. I flip around a little bit. I look at BBC for global because none of the local station, none of the U.S. cares about global news, and that's really, I like to watch that once in a while. But other than that, I'm not a big news guy. Period. So.
Yeah. Perfect. Well, Hans, thank you again. Why and how should people reach you?
Actually have created a course here that we went over part of it, but I did a whole day, and it's being made into a course. And then I also, run my own deals. So, if you're ever interested in learning more about what we do, I'm happy to talk to you if you're an accredited investor. Obviously, we have to get to know each other first before you could ever invest in our deals, but I'm happy to get to know somebody. You can reach me at hbox@boxwilson.com, hbox@boxwilson.com. Or just go to boxwilson.com and reach out there. Happy to chat anytime.
Perfect. I hope people feel more confident to know the validity behind an investment's financial projections. So until next time, adios.
Thank you, Bella.
If you are ever interested in a recap with the main points discussed throughout the podcast episode, Check out the Q&A series because we dig deeper into the concepts discussed, and you can follow along on YouTube if that's preferred. If you find any value in the show and want to support it, it would be awesome if you texted someone right now about it. You can say you have a podcast recommendation that you think they should listen to and then ask them to get back to you with their thoughts. Anything helps, and I really rely on the amazing investors like you to spread the word. Thank you so much for listening, and please feel free to reach out at any time.